Everyone, welcome back to the Week in Charts, where I run through the most important charts and themes in markets and investing. Another big show this week. We're going to talk about the bear market in stocks. We're going to talk about inflation. We're going to talk about housing and a lot more. Today's show is brought to you by my friends at Y Charts. Take a look at the show notes to get a link to a free trial to Y Charts and 20% off when you first sign up for the service. So let's start out with the inflation picture. We got another reading last week, and it showed the first tick lower inflation in quite some time in the U.S. So 8.3%, still pretty high, but lower than the prior month, which was 8.5%, which is the highest we've seen in 40 years. So if we look at the breakdown in terms of the components, still pretty high across the board. We're seeing big increases in terms of energy prices. So fuel oil, if you're heating your home, 81%. Utilities still pretty high, 23%. Gasoline, of course, everyone's seeing that. We had another new all-time high in gas prices this week. So 44% increase there year over year. But also importantly, we're seeing almost 11% increase in food prices. So if you're going to the supermarket, you're probably noticing that. And the big one here that I believe is still understating the true rate of inflation is that shelter component, which is showing only a 5.1% increase over the last year. And why do I believe that that's understating the true rate of inflation? Well, because rental prices in the U.S. are up around 16% year over year, and home prices are up 20%. So if this number continues to increase, we're likely to see continued upward pressure on the CPI going forward. And if housing at 1/3 of the index, if housing inflation was being reported at the actual rate, we'd likely be seeing a much higher rate of inflation than 8.3%. So what does this mean in terms of the average worker? Well, as we've talked about, we've seen a big increase in hourly wages, which would normally be a really good thing. So since February 2020, when the pandemic began and we borrowed a lot of money and printed a lot of money, we've seen wages now up 11.5% in the U.S. These are average hourly earnings in the U.S., 11.5% increase. The problem with that is if we adjust for inflation, it's down to zero. So down here on the bottom chart, we're showing that inflation adjusted hourly earnings are flat since February 2020. And how do we get here? Well, we started out with big increases relative to inflation. So inflation only happens with a lag. When you have an increase in the money supply, an increase in debt like we've had, it seems like it's a good thing initially because wages are outpacing prices. But over the last 13 months, we've seen the opposite. So we've seen wages in the U.S. fail to keep pace with inflation for now 13 consecutive months. And people are starting to become concerned about that. And we've talked about the impact on consumer sentiment, but we now have another tick lower in that consumer sentiment index, 59, lowest since 2011. And if we look historically, this index goes back quite some time, with the exception of the 2011 bear market where the S&P fell 20%. We've only seen this indicator this low during recession. So the 08, 09 recession, 1980 recession, 1973-75 recession, we saw readings this low. So people are wondering, are we in a recession? We've had now 1/4 of negative GDP growth. We'll see if we stabilize from there. But it's really a reflection of, I think, the higher inflation picture and the fact that wages are not keeping pace with that higher level of inflation. So the big question is, will the U.S. consumer start pulling back in terms of their discretionary spending? We haven't seen much evidence of that yet, but we're going to look closely at the retail sales report for this month to see if that starts happening. So the fear is that now that the stimulus is starting to be used up, the consumer has less savings to draw from. And if they're spending more at the gas pump and spending more at the supermarket, they're going to have less money to spend on discretionary items. So again, still haven't seen evidence of that. There still appears to be pretty high demand in terms of the consumer, but that's the fear of what could push us into a recession. So I did a poll on Twitter asking, has the inflation rate peaked in the U.S.? and around 55% said yes. So it looks like the majority of people are thinking that inflation is headed lower from here. Why are they thinking that? Well, it could be a number of reasons. One, if we do get that recession, that will likely cure the demand side of things, and you're going to see prices fall from lower demand. We also have the Fed, of course, normalizing policy, and we'll talk about that in a little bit. So maybe people are thinking with higher interest rates, that's going to also lead to a decrease in demand and lower prices. And then there's just the function of the year-over-year comps start to become more difficult in terms of prices were high, starting to be high last May and June. As we look at the year-over-year increases over that period, it'll be more difficult to show continued increase from there unless we see another leg up in terms of the price of commodities and wages or housing prices. So a lot of different factors driving this, but interesting to see that a lot of people now are thinking that maybe that inflation rate has peaked, and hopefully that is the case. But in terms of Fed policy, where are we? So we know the Fed hiked now 50 basis points, and so they're getting closer to a normal rate, but how much closer is the big question. And I think this chart really tells the story here, looking at the rate of inflation, CPI, versus that Fed funds rate. So Fed funds rate now is at a range of 75 to 100 basis points, and we have CPI at 8.3%. So this is still a huge gap. So while they're moving towards normalization, they're really still very, very easy given the rate of inflation. We haven't seen a spread this wide since 1974. And if you remember, 1974, another highly inflationary period, that was a recessionary year. So the recession that year did eventually bring inflation rate down. And really, that's the question. How is this gap going to be closed? Is it going to be from the Fed hiking rates or from the CPI coming down? And as I said last month, I think it's going to be a combination of the two in the near term. But we certainly don't want to see a recession bring it down. But that would be one way that it would come down pretty rapidly. So if we're looking at global central bank rates, where does the Fed stand in terms of relation to other central banks? Well, we're up here, still very, very easy compared to other central banks. This is looking at the central bank rate versus CPI and looking at the real central bank rate. So taking that central bank rate, subtracting CPI, and where are real interest rates still highly in negative territory. So the Fed is not alone. As you can see, most central banks are maintaining negative real interest rates in terms of their policy rates. The ECB is the most one of the most egregious here. Negative interest rates in spite of 7.5% inflation. So really disconnected policy. But we have Denmark, Sweden, the UK, Canada, all still highly negative, all still behind the curve to a large extent. And the expectation is that gap is going to be closed, I guess, in two ways. One, with the inflation rate coming down, but two, more importantly, with continued rate hikes. So if we look at expectations, this is a really interesting time for the markets because the markets is still expecting 50 basis point hikes in both June and July from the Fed. And that's in spite of the big decline we've seen in the equity market. And this is not something we've seen in recent history. In recent history, if there was a 20% decline in the S&P, the Fed would be easing policy and easing pretty aggressively. And this time, they're not doing that. They're not only not easing policy, but they are hiking and creating more restrictive conditions. And we haven't seen that really since the early 1980s under Volcker. And so very different environment where you have stocks under pressure, you have economic weakness in the first quarter. And in spite of that, the Fed it still feels like they have to hike interest rates because they're so far behind that curve, as we've talked about. So if we're looking at the next two meetings, again, 50 basis points priced in for the June meeting, that would bring the Fed funds rate to 1.25% to 1.5%. And then if we look at July, another 50 basis point increase, which would bring the Fed funds rate up to 1.75% to 2%. So continued hikes expected. From there, it's not as aggressive. We're looking at around 2.5% for year end. So the expert market is expecting a slowing in terms of after that July meeting. slower rate of increases. But I think a lot of that's going to be path dependent, dependent on what goes on in the economy, the stock market, and inflation. So if the Fed sees that the stock market continues to fall, are they going to be as aggressive hiking into year end? Likely not. If there's a recession, of course, you're going to likely see interest rates slow down the rate of increase. And if that inflation rate comes down significantly, the Fed won't feel like they have to hike as fast. So a lot of this is going to be dependent on the data from here. But in the near term, the Fed made it pretty clear that they still view inflation as a big risk today, at least, and that they have to continue to hike rates in order to get it under control. So if this brings a practical question for investors, everybody's got checking accounts, savings accounts, and of course, when the Fed cut rates to zero back in 2020, you're earning nothing on those accounts. And now that they're starting to hike, you're going to start to earn something again, but you got to look around, you got to be active about it. So if we're looking at savings rates across some of the bigger banks, if you have a Bank of America account or Chase or HSBC, Wells Fargo, you're still earning, Citibank, you're still earning pretty much nothing on your cash in a savings account. And the national average is only at 0.06%. But if you do some shopping, you look around, the highest rate I could find, I just did a search before this video, I found a savings account for 1.25%. So not huge, and certainly not huge given the rate of inflation, but at least it's something, and it's likely to continue to go up in the coming months as the Fed continues to hike rates. So two things I found, two banks, and there's probably more out there. Basque Bank, 1.25%. And Bread Savings 1%. So these are FDIC insured, so they're not at risk, up to $250,000 per depositor, and so you can at least get something on that savings where you're not thinking about investing it, but this is savings that you'll either have for an emergency. Or that you want to use in the future for a house payment or anything other than investing in something for the long term in terms of stock market, you might as well at least be getting something on that cash. And now the positive from the Fed hiking rates is now at least you'll be able to do that. So in terms of the markets, to put things in perspective, how bad this start to a year is, I created this table here. It goes back to 1928, and really through the first 91 trading days, S&P's down 7.5%. This is the second worst start to a year in history. You have to go all the way back to 1932 during the Great Depression to find a worse start to a year. And so that's pretty bad. If we look at what happened following these prior examples into year end, it's kind of a mixed bag. Sometimes the market continues to go down. Many times it rallies back. It's pretty difficult from these levels to get to a positive return. Nothing is impossible, but it just shows you just from that start of the year how bad things are. Now, of course, it could always get worse, and the S&P's down 20% peak to trough. But in terms of sentiment at the start of the year, looking at where we are in May, we haven't seen this in a long, long time. And the problem for investors, if you're an investor in stocks and bonds, is that it hasn't really just been limited to the stock market. It's also the bond market. So if we're looking at the Barclays aggregate, this goes back to 1977. We have full calendar year data. Bond market's down over 9% this year. That would be the worst return in history by 3x. So prior to this year, 1994 is down just under 3%. And here we are down over 9%. So it's been a really long time since we've seen both stocks and bonds down together in a calendar year. In fact, I went back to 1976 and looked. The last times the 1, 2, 3, 4, 5, 6, 7, 8. So the last 8 years that the S&P had a down year, bonds finished higher. And so that's not unusual because usually when stocks are down, interest rates tend to fall, the economy tends to be weak, and bonds benefit from that. And this has really been the opposite situation year to date, where we have that economic weakness, we have stocks falling, but interest rates are rising. So the cause of the economic weakness this time around is that rise in inflation, rise in interest rates, and that's causing pain in both stocks and bonds. So S&P down 17%, bonds down 9% year to date. We haven't seen that in a long, long time. And just going back to 1976, which is all we have data for the bond market. If we look at a 60-40 portfolio, so 60% stocks, 40% bonds, down, this is through the end of April, down 11.5%. That's by far the worst start to a year that we've seen for a 60-40 portfolio ever. So in terms of the stock market, this is something somewhat unprecedented we haven't seen. So if we're looking at averages going back in time, we tend to see a 20% bear market every 4 years on average. And so what's been interesting about the last few years is now we're back in a bear market essentially. So I rounded up here. The S&P was down 19.92% peak to trough. And so I rounded up to 20% because it's pretty much a bear market in anything other than the S&P. We have the NASDAQ 100 and small caps, the Russell 2000 down over 30%. We have growth stocks down over 70%, as we'll talk about a little bit. So for everything else, it's a bear market. So I think this is pretty safe to say it's a bear market for equities, even if we didn't hit that magic 20% exactly in the S&P 500. And now this is in less than 4 years, it's the third bear market we've seen. So 2018, 2020, and here we are again with the third 20% decline in less than 4 years, which tells you that averages are just averages, and anything can happen in markets. And just because something has only happened every 4 years in the past doesn't mean that there's going to be a 4-year period exactly between these events. And so you can have much longer periods, as we saw from 2011 to 2018. We had a 7-year period without a bear market. We also had that from 1990 to 1998, an 8-year period. So you can go long periods without bear markets. And now we're really on the other side of that. We're seeing bear markets, then huge rallies, another bear market, then huge rallies. So it's really been more of a boom and bust type of market over the past few years. And the big question for market participants is, are we there yet? Is this enough? Is this enough selling in terms of the markets? And one area that investors are looking at closely is that high growth area. And as we've talked about, the ARK Innovation ETF has really been the representative of this area of the market. And the declines there have been stunning. So from the peak in February 2021, so remember these high growth stocks peaked much earlier than the market. So the S&P peaked in January of this year. These stocks hit a high in February 2021. So we had a long period where the average stock was really underperforming the market to a large degree. And now just recently, the market as a whole is starting to catch up with that. But in terms of this ARK Innovation ETF, now down 78% from its high in February 2021. If we compare that to the NASDAQ composite back in March 2000 to October 2002, same percentage decline, 78%. Does that mean that the selling is over? It doesn't have to be. No, it could certainly go down more than that. But this just gives you an idea of how quickly these stocks have repriced. So in a 15-month period from February 2021 to May of this year, down 78%. That's a pretty quick decline. You have a 31-month period here for the NASDAQ hitting that same level of decline. And where does that bring us back to in terms of ARK? Well, it's right back down to the pandemic lows. So pretty stunning reversal. All of the gains from those pandemic lows to its peak in February 2021 have now been given back. And if we look at a lot of the names that are in this ETF and just high growth names in general, what we saw is a huge multiple expansion in 2020, just enormous gains for a number of these stocks, pulling forward years of returns. Multiples really we haven't seen since the dot-com bubble. And after they peaked in 2021 and 2022, we've seen a mean reversion back down to those lower levels. So we have 50, 60, 70, 80, even 90% declines in some of these high growth stocks. And so are we there yet? That's the question. Have valuations hit are they low enough to hit a bottom? Well, again, I'll keep coming back to this chart to say we could certainly, the declines could certainly stop here, but it won't be because stocks are cheap. This is the median price to sales ratio of the NASDAQ 100. And so we're kind of back now to 2019 levels. And so certainly much cheaper than we were. 30% decline in the NASDAQ 100 is not nothing. It's certainly something better place to buy today than November of 2021. But to say that it's cheap, it's hard to argue that when 10 years ago we had a 3x price to sales ratio. So it can always go lower. Investors should be prepared for a 50% decline or more in these stocks because of the run up that we had. So that basically that 30% decline in the NASDAQ 100 is just really erasing last year's return. That's, it shows you how much this index has gone up in recent years, that we're only giving back a year or so in terms of return. We're back to 2020 prices in terms of late 2020 prices in terms of the average NASDAQ 100 index here. And so that's certainly a big give back if you bought last year. But you could give back, as we've seen in this prior chart here, you could give back years worth of gains if this is going to be a bigger bear market. Nobody knows the answer if that's going to happen, but it's certainly a possibility, of course. So in terms of sentiment, in terms of what these declines has done to investor sentiment, this is, I'd say, the one positive if we're in terms of markets right now, is that everybody is pretty much in that bearish camp. There's so many reasons to be bearish. You can pick and choose from inflation to the economy to valuations to any number of things, and they're all good reasons to be bearish. And the only reason to be bullish is that everyone else is bearish. So this is CNBC does this special called Markets in Turmoil. They've been doing it for some time, and they only really do it when stocks are down big. And so I've been compiling this list for some time, and this is a list of all prior Markets in Turmoil specials that I've listed here, and what the S&P did 1 year later. As you can see, thus far, 100% track record in terms of the CNBC does this Markets in Turmoil special, and 1 year later, the S&P 500 is higher every single time. And the good news is on May 5th, they did a Markets in Turmoil special. So we'll see a year from now what will happen. What's the caveat with this chart? What should investors be thinking about in terms of why this possibly might not work going forward? Well, these are all data points in a market that has seen corrections be very short-lived. So really from the lows in March 2009, the S&P hasn't had a bear market or correction that wasn't followed with a new all-time high in relatively short order. So if this is going to be a longer-term bear market like we saw in 2007 and 2009 or 2000 to 2002, the CNBC is going to do one of these specials, and there's going to be losses that follow, right? So we don't know if that's the case today, but that certainly could be, and investors should be aware of that. Does that invalidate this as a signal? I don't think so. I think that it's for investors or traders, it's better to see a Markets in Turmoil special than regular programming, because it's an indication that sentiment is pretty bad, and you're more likely to see better returns going forward. So if you're an investor in stocks and in the S&P down 20% or other things that are down 30, 50, 60, 70% or more, today's a better time to be a long-term investor than when you have just regular programming. So it's a good sign to see sentiment. It's a good sign to have fear in the markets. This isn't the only sentiment indicator, of course. This is another one that I look at. It's going back to 1987. It surveys individual investors every week, asking what their opinion is of the stock market over the next couple of months. And investors haven't been this bearish in this AAII sentiment survey since March 2009. And very few times in history we've seen, only two times really, the 1990 bear market and recession and that 2009 indicator, we've seen this indicator this low. So sentiment's pretty bad, rightfully so. As you can imagine, stocks are down, interest rates are going up, inflation is very high. We have war still going on. And so there's a number of reasons to be bearish, and investors are there in terms of sentiment. The good news, again, with this indicator, if you go back and look a year later, the returns following very bearish indicators are better than the average reading. So you'd rather see investors extremely bearish than not if you're a longer term investor. And in terms of fear and greed, everyone remembers Wall Street, that famous quote by Gordon Gekko, where he said, "Greed is good," and and that might be the case for what he was trying to do. But in terms of investing, it's the opposite. Fear is good, and why is that? Because fear creates panic, panic creates overreaction, and that creates an opportunity in markets. And so when investors panic, stocks go down, the prices that you're paying for stocks or it gets better, and that should lead to better longer term outcomes. And greed is, of course, the opposite. So what we saw with, as we talked about all last year, with IPOs and SPACs and memes, that was a sign of excessive greed. And what that led to was a very bad risk reward for investors. And so now we're getting to a better place. We're repricing a lot of those areas. And the fear in the markets is a good thing. It could always become more fearful. And if it does, it'll be an even better opportunity for longer term investors. So I got to touch on housing here. I know we've been talking about it a lot of late, but it's very important because unlike the stock market, you don't see housing prices in real time. So I think we haven't really seen the damage that's probably there already. And why do I think there's damage there? Well, it's just really an affordability question. The mortgage rate in the US, the average 30-year mortgage rate is up to 5.3%. That's just a huge increase. It's doubled essentially since the lows just last year. So the all-time low is 2.65% in early 2021. We've now doubled the rate. And so in terms of the math for a home buyer, I tweeted this out recently. If we're looking at January 2021, you have a 2.65% mortgage rate. The average home price in the US was sold for $401,700. Today, you got a 5.3% mortgage rate, average home price much higher, $523,000. And now what that does to the down payment is an 80% increase from $1,294 to $2,327. 80% increase is enormous. And this increase doesn't include things like taxes and insurance and repairs and maintenance, which have all gone up significantly as well. So the affordability picture has really changed. And here's a chart illustrating that. It's at the, if we're looking at the housing affordability in the US, it's at its lowest level since October 2007. This is just data through March, so it doesn't include the really recent spike in mortgage rates. So mortgage rates are up over 1% since this index ended in March. And so what it means is affordability is even lower than what it's showing here on this chart. And what that should do in terms of demand, it should decrease demand and it should start to level out in terms of price appreciation. So remember, home prices in the US up 20% over last year, record highs. And we're not seeing yet in the data, but I expect to see a significant slowdown, if not a correction, in the months to come. Because you can't have this huge change in terms of affordability and demand and not have a readjustment in terms of prices. So that's another question for the economy. How will it handle repricing in terms of the housing market? Will that lead to a decrease in demand in other areas? Will that cause problems? And that really remains to be seen. As we talked about, housing prices are much slower to adjust than stock prices. People are living in their homes. They can, unless they lose their job and they're forced to sell, they don't have to sell. So they simply take their houses off the market when they see prices start going down, hoping that they'll come back up again. So it takes more time to see an adjustment in prices. We haven't seen it yet, but I think you have to reasonably expect correction in the housing market to come, given this change in environment here. So let's talk about two positive things. We talked about a whole slew of negative things going on in markets. If we're going to point to two positive things, number one would be the labor market, still very, very strong. We still have this huge gap in terms of enormous number of job openings, over 11 million job openings in the US. That's a record high. And we have the number of unemployed people very low. So the spread is very wide. And the result of that has been a new high in terms of private sector jobs. So this is really the greatest jobs comeback we've seen in history. So ADP report last month showed another increase in payrolls, and now we've recovered all of the losses that we saw during the pandemic. So if you're still out there looking for a job, hopefully the weakness that we've seen doesn't cause this dynamic to change, but there still seems to be a ton of job openings out there. And so the jobs market is still healthy for now. And that's a good sign because normally during a recession you see the job market suffer. So we'll be looking for signs of weakness there. Leading indicator of that would be in terms of jobless claims. If we see that start to tick up, that would be problematic. But for now, the expectation is that we'll see continued jobs growth in the months to come. And that could be a positive in terms of the inflation picture as well, because as we've talked about, wages have been very high, which causes inflation in general. And a lot of that has been because of a lack of supply in terms of the labor market. So if people start coming back to work because prices are so high, then that could drive down wage growth and lower the overall rate of inflation and really help companies supply the supply chain issues that they're having because of labor shortages. So it could be helpful in a number of ways. So this is one positive really to hold on to here. Again, hopefully it continues in the months to come. Number two would be on COVID. And so let's take a look here at the number of deaths per day for COVID-19 in the US. And now we're down close to 90% from the peak in January 2021, just a stunning decline, lowest level since the start of the pandemic. So we're at 230 deaths per day in terms of COVID-19, and we are at 3,500 a day in January 2021. And as we've talked about, two big factors driving this in terms of immunity. One, we have vaccine immunity, and two, natural immunity, where now a substantial portion of Americans have already gotten the virus. That leads to lower severity going forward. And we have close to 80% vaccination rates as well. So those big factors have really changed the game in terms of the pandemic, making it much less severe in terms of fatality rates. And that's going to lead to a continued reopening, in my view, of the economy. And we're seeing that in terms of the travel numbers. And I expect to see that continue into the summer in terms of we're looking at the TSA numbers. We're seeing really the highest numbers of travelers per day on airlines that we've seen since the start of the pandemic. So two positive things going on, and hopefully we'll see more of these positive things going on in the coming weeks. And so that's it for this week. Thanks everyone for joining me. Have a great week, and we'll see you next week.